that's one of the curious things about this legislative approach to proof of work. You actually see that miners, that this industry has incentivized miners to go and set up where they have the cheapest source of energy, which is also usually where you have renewable energy.
Yes.
So it does have a knock-on effect that is positive in a way, because I'm going to set up my mining operation where I have cheap energy like geothermal, or in El Salvador, under a volcano, or, hydroelectric dams, or, whatever else.
Welcome to Grokchain Conversations. This podcast is presented by a multidisciplinary group of legal, financial, and technology professionals to meet and discuss today's most pressing questions around the use and governance of the blockchain. Through roundtable dialogue, we will provide listeners with a full spectrum of views on where this technology is today and where it might be leading. The information provided on the Grokchain Conversations is for educational purposes only. The information provided does not constitute legal, investment, financial, tax, accounting, or any other professionally licensed advice. The views expressed here are those of the individuals, not those of their respective employers or Grokchain. Today's topic of conversation: considerations for the harmonization of the U.S. executive order and the EU regulation on markets in crypto assets.
Hello, everybody. Welcome back again. We're joined again by Alessandro and Marina. We're going to have hopefully a focused and quick conversation today. We want to start off by talking about what's happened in the last 2 weeks since we last talked. A couple of relatively large things on a governmental level have happened in the blockchain digital assets world. What I wanted to start off by talking about was the March 9th executive order. The executive order was called, from the United States, the executive order on ensuring responsible development of digital assets. Now, one of the first questions a lot of people are going to have is, what is this? What does this mean? Basically all questions, right? But an executive order, let's start with this, is a directive issued by the President of the United States, acting in his capacity as the head of the executive branch of the United States government, compelling a federal official or agency to engage in or refrain from a particular course of action. So this is one of those. This is an executive order. This March 9th executive order specifically concerns digital assets, which is inclusive of the cryptocurrencies and blockchain currencies, the blockchain technologies we were talking about. Not everything, but includes a lot of this. And what it's done is not necessarily as clear, especially to the casual viewer. There's not now a whole new framework of dealing with these digital assets in the United States. The biggest thing it's done is the head of the U.S. executive branch has now acknowledged that these digital assets exist. That may not seem like something, but it's a big deal. It's acknowledged them. It's directed the U.S. agencies to all work on accomplishing certain goals. Now, what are these? These are, financial stability, curbing illicit finance, financial inclusion, making sure these markets are available to everybody, responsible innovation, and exploring the viability of a U.S. central digital currency. Now, that's one of the big ones, right? The idea of the U.S. having a central digital currency is a huge step in this space. And the fact that it's coming from the top down from the president with a directive to all the agencies mean they should all be working more or less in lockstep to explore this possibility. Reality is not quite as clear because the bureaucratic ins and outs of what this executive order means and what the agencies do is twisty at a minimum. Now, some of that you'll see if you actually take the time to read through the executive order. The president doesn't ask the same things of every agency. Some agencies it asks nicely to do things, other agencies it directs to do things. That's not a signaling of what the the president sees as having the main regulatory or other control over these digital assets. It's kind of a reflection of the realities of the internal bureaucratic workings of the US government. What I mean by that is the Treasury Department works directly for the president. So the president executive order could say, get this done in 60 days, give me your report back. And if they don't do it, he could typically fire the people involved. Other regulatory agencies like the SEC and the CFTC don't work directly under the auspices of the president. So the president can ask nicely in executive order and ask for the reports in, say, 60 to 365 days, depending. But those agencies don't really have to do it. So you have to play nice. As I mentioned, that doesn't mean that the regulation framework's been upended, because the Treasury Department has done very little on the digital asset front. That doesn't mean nothing, but it hasn't been directed to do so by presidents before, so it hasn't done as much. Whereas a lot of the regulatory weight has been taken by the CFTC, the Commodities Future Trading Commission, and the Securities Exchange Commission, the SEC. They are active in this space. You know, there are opinions and letters out there having to do with DAO functions going back more than 5 years now. So they've been out here dealing, at least talking and thinking about these issues for a while. But now the order has told everybody, hey, catch up and get back to me so that we can start thinking about these things. Now, nothing immediate is done by this executive order. It's more of a statement of purpose. And that is the main takeaways from it. Now, it's important, but it hasn't changed everything yet. And it's an opportunity to get involved with these conversations. Alessandro and I and Marina and I were talking just before recording started, and he mentioned how some of these agencies are sending out tweets asking for, hey, reading book recommendations. Is that right, Alessandro?
Yes.
Yeah. And that there's a real opportunity in that. But it's the beginning of the process. It's the beginning of a regulatory process and not really close to any kind of legislative process like actual laws. Now, with all that said, we've got Marina on the line, and Marina can talk to us fairly extensively about, there was actually a big vote on, I believe it was March 14th, having to do with proof of work technologies, and also overall what kind of the legislative realities in the EU are. Marina?
Yes, thank you so much for this intro. So in EU, we have kind of a different situation that you have, of course, just from the way how the EU is organized and from our legal system, but also in terms of when we think about where we are with the regulation that is defining crypto assets, as we call them in Europe. So everything that is represented as a token or something similar. And so I'm sure that most of you already know, when like all the listeners, they heard about the markets in crypto assets regulation, which is basically a regulation that is regulating the issuance and also of this crypto assets and all the service providers that are kind of linked to the crypto assets. So the service providers are the ones that are defined in the draft. Not, of course, all of them, but all the major ones. Let's say exchanges, all the wallets, even financial advice on crypto assets, but very like the major existing ones. And how it is different from the US is, maybe I will start with a timeline. So we are all kind of aware of what's happening, how long this takes, and how the legislative process in the EU even takes and how it looks like. So it all started on the 24th of September 2020, with the European Commission adopted its own proposal and then put it public. So this is how usually the whole process starts. The European Commission is the one that is drafting those proposals, and then the next phase is when it goes to the council. The council is represented by the member states and from their different ministries. So in this case, because we have crypto assets, it was by their financial ministries, which can be also quite I would say, quite an interesting process, because you know that there's a lot of member states in the EU, so everyone needs to give their own opinion, and it also depends on how the member state that is presiding the council is also working on this, and how much of a priority is putting on this topic, and even how much capacity it has to work on this. So MiCA started in September 2020, and then there were different member states that were presiding during the time until the council adopted their own proposal, which was the final one, and this happened last year. Sorry, yeah.
If I can interrupt, MiCA, I don't think I introduced the idea of that. Can you tell us what MiCA is real briefly?
Yeah, absolutely. Yeah.
Please.
So MiCA is a regulation that regulates all the issuers of crypto assets and all the service providers of crypto assets. So it's basically a regulation that is kind of an overarching regulation that regulates the activities around crypto assets.
Well, what does it stand for?
Markets in Crypto Assets Regulation. Yeah.
Okay.
And is it already in force, or is it something that's still being debated?
Sorry?
Is it already like an actual active regulation, or is it something that's still being crafted?
Yeah, it's absolutely in the process of being crafted. So it's not finalized yet. The thing that I was just describing is just how the process looks like, and this is where MiCA is at the moment, is in the third, or like I would say, the third phase. So the first phase was when the Commission issued a draft, and then the second phase is when the Council proposes their own draft, and the third one is when the Parliament proposes their own draft, and we are right now here. So the third phase, where the Parliament is trying to define their own proposal. I think it will take another few days to know how this is going to look like. If it's going to be voted on the European Parliament plenary. And then the final part is the fourth part, where there's trilogues, which means that all those three institutions, they come together and discuss what is going to be the final draft. So what we will know in a few days, having the last draft from the European Parliament, is what is going to be put in the final draft, because nothing new, no new amendments can be proposed. So if we have those three drafts, we know that the final one is going to be a combination of all of those three ones. And at least this gives a little bit of certainty, and especially when it comes to the really debated topic that was very debated last week, about a proof of work ban. And so last week, on the 14th of March, there was a voting within the European Parliament committee, Econ committee, about this article that was at the beginning a second 2A article. And there was like different proposals from the Greens and from the other parties. And between them, it was quite a big difference. One was suggesting that from 2025 in the EU, the consensus mechanisms that use a lot of energy, they would be banned or like significantly hindered. And the other one suggested that from 2025, the crypto and like all the blockchains, consensus mechanisms would be put in the taxonomy, which means that would basically at that time would be looked at from the sustainable finance point of view. So there is an EU sustainable finance taxonomy that is not going to be specific for crypto, but with this proposal, crypto would be included in this. And what basically this means is that probably there is going to be incentivized in a way that they would, different industries would rather use something that is using less energy. So probably this is not going to be a proof of work system, but it's going to be probably proof of stake systems. So as you may know, the second proposal was voted on successfully. So right now, as we have like the draft that we have today from the European Parliament, it doesn't say that from 2025 those consensus mechanisms would be prohibited, but that they would be included in the EU sustainable finance taxonomy. So we don't know exactly what this means, but I think we'll figure it out quite soon.
But it's your feeling that it'll end up greatly favoring other kind of technologies like the proof of stake. Is that the way it's leaning if it gets included in the final vote?
Yeah, absolutely. This is the way how it's leaning. I mean, right now we know about few consensus mechanisms, proof of work, proof of stake, and maybe a few others, but we don't know what will happen in 2025. Maybe we'll have a new one. So they're not defining it with the exact words. They're just saying that consensus mechanisms that are using more energy, they will probably be not used, or they will not incentivize them to use them.
So do they define what the thresholds are for a lot of energy? Like you said, they're not defining terms. So proof of work by itself wouldn't be a problem. It's just inefficient proof of work, I guess, right?
I think that in a way, how it was described, it just depends on the numbers. So they will, it's not defined yet, because this is kind of the process. It first defines the draft, and then they would go into this like more technical part. But right now it is, as we see, it's going to be really just like some numbers. So I don't think that how we call one consensus mechanism or the other would be like a big difference. So yeah.
Yeah, okay.
Going to be very
They're
pragmatic.
They just made a decision to make a decision about the numbers later, I guess, right? The specific numbers.
Yeah.
They just gonna matter. And it's gonna matter if it's costly from an energy perspective.
Exactly.
Right? Okay. Well, yeah, that's interesting. Yeah, that thinking about it is not anywhere close to what the US thinking about it is. I mean, there's obviously public debates about these energy costs. But it's not part of the policy thinking, as far as I could tell. Let me look at the EU.
No, actually, New York State just announced that they want to take a look at proof of work in New York State, and possibly, I think they're going to, well, I don't remember what the legislation says, but I think it's to ban it for 2 or 3 years. Something like it came out yesterday or the day before.
Very interesting. I would love to read that, because when we are talking with our American colleagues or projects that are based mostly in US, they're saying that they do not expect something like this happening in US. And this is also why I think we would see that there would be like a difference in how EU versus US or other countries are treating this topic, and would be quite a, I would say, like a bad thing from like the competitiveness of different projects from the EU perspective.
Well, you have to remember, proof of work is a security protocol. It's part of securing a distributed computer network. So if you ban the use of proof of work as an absolute, if you like, you're basically saying that you're removing the security guarantees that particular technology provides the users. That said, there are people who are looking into proof of work, but not using electricity, using light. So processors that are not using electricity, but optical processors, which use a lot less electricity, and are apparently, not a technologist, just like to study stuff. Apparently it gives you the same security guarantees, but at a much lower cost.
Yeah,
Cost.
And that's part of what I think Marina was saying, that even the EU acknowledges that whatever you label it as long as the costs aren't that high, they're not going to mind on the EU side. But to explain to our non-US based people, or even the US based people who don't understand it, the executive order is the federal government, the head, the executive of that coming down with a directive. But the states operate on their own to a large extent. So New York State can kind of issue this proof of work ban that Alessandro was talking about. I've seen some coverage on it. It's unclear exactly what the ban would do for kind of the security reasons Alessandro was talking about. What seems likely they would do is prevent actual mining in New York State, because that's where the actual energy costs are. But New York's not cheap enough for there to be any large scale mining from an electricity perspective anyway.
No, actually, there has been a lot of investment in New York State. After the companies got kicked out of China last year, a lot of them moved to Texas, some of them to Kazakhstan, but a number of them moved to New York.
Well, then they're going to be
set up. They've set up upstate, like right near the power producers. It's mainly hydroelectric.
Well, that makes a lot of sense, because historically, correct me if I'm wrong, there's been a lot of activity on this in Iceland because of the electricity for geothermal.
That's geothermal, yeah, right.
Yeah.
Well, that's one of the curious things about this legislative approach to proof of work. You actually see that miners, that this industry has incentivized miners to go and set up where they have the cheapest source of energy, which is also usually where you have renewable energy.
Yes.
So it does have a knock-on effect that is positive in a way, because I'm going to set up my mining operation where I have cheap energy like geothermal, or in El Salvador, under a volcano, or hydroelectric dams, or whatever else.
Mm-hmm.
So the economics still play a role, and it's kind of a double-edged sword, because the incentive mechanism that gives you that security is related to the fact that energy has a cost. So now if I go and set up where I have very little cost or low cost energy, well, do I still get the same security guarantees, because now it's cheaper for me to reorganize or fork the chain?
Yeah.
Or the optical CPUs as well. That's a difference.
Another wrinkle. It's tough, because on policy side, I don't think the US government's deep enough into the technology to be able to think about the nuances that you're talking about here. For the most part, they're just wrestling with the existence of this technology, right?
That's why we have Grokchain.
Yeah,
that's what we're here to do.
Yeah, that's what we're here to do. And because of the way the U.S. political structure is set up, it's kind of intended for there to be some experimentation on a local level, on this state by state level, for New York to try this and then see what the economic consequences are in the short term, and then change it or not. And then also the states can't just do whatever they want. To the extent they contravene one of the core values of what the federal system's supposed to accomplish in the US, the federal system will preempt it. So there could be a circumstance in which we see, there are 50 United states in the United States. We could see 15 or 20 different regulations on cryptocurrency in the near term, or blockchain technologies in the near term. In the next 2 years, you could see the federal government getting their act together enough to say, no, we're going to preempt and clear the field on all these, and they're invalid. It's certainly
the same thing in Europe. You got 27 countries, all of them doing their own thing in the meantime. And then once MiCA and some other legislation comes out at a European level, they're all going to be asked to harmonize. And every country, like usual, will harmonize in their own way. So you'll still have a little bit of a patchwork, but more of an overall consistency throughout the European Union.
Yeah, it's very different from like different topics. And let's say the situation at the moment is that different member states, they already have similar laws on crypto or maybe even AML. Let's say Germany, France, Estonia, and some others. There were a lot of regulation regarding crypto in terms of what kind of license is needed to operate in this member state. So let's say about custody or exchange and similar. And right now the situation is that some countries do have this legislation, some don't have it, like some have zero. And a lot of them are already waiting, maybe they had something prepared or maybe they want to change some of their laws, but now they're waiting to see what will come up with MiCA, because MiCA is going to be a regulation which basically means in the European Union terms that is going to be directly applicable to the member states. And it means that it will be identically applicable to all of them. So that there's no like period that they would need to, for example, coordinated with their own legal system as the opposite of a directive. And this is also where it could be kind of problematic in a way, just because of MiCA being so the markets and crypto assets regulation being very similar to the directive. That is, again, a directive, is not a regulation from that regulates financial instruments or securities. And this is called MiFID. And so sometimes they would clash, or at least they would, like MiFID is covering the financial instruments and crypto assets regulation, like MiCA is covering other type of crypto assets. And so there could be a potential clash in the future just because MiFID is adopted in France in a different way as it is in Poland. And so if MiFID defines in a different way what a financial instrument is, then it also kind of links to how MiCA defines what a financial instrument is not. So that's going to be interesting, but probably in the next, not before the next 3 years, because just going back to MiCA, we expect another probably 9 months of negotiations within the trilogues. So probably the draft is going to be finalized by the end of this year. And then there's going to be few additional months, I think it's 18 or something similar to for it to come into force. And that's then at that moment where all the service providers that want to present their services to the European Union, they would need to be compliant with it.
And service providers in this context, that's defined as what? Is that like a GDPR term or?
So the MiCA is regulating issuers of crypto assets. So the issuer is anyone that is issuing a crypto assets. And then of course it defines what crypto asset is. There's 4 different types of crypto assets. And the other thing is that it defines also what is the service provider. And the service provider as per MiCA is different from the GDPR, and it's this specific for MiCA because it's a specific regulation. Usually it is about exchanges, custody, and other service providers that are offering similar services to the European Union market, which means that it's not that important where they're coming from. They would need to, as MiCA and requires in one draft, that they would need to incorporate in one of the member states of the European Union, which could be quite interesting because, as we know, most of the blockchain companies, crypto companies, they are incorporated in Switzerland at the moment. They might have another company in the US, but not many of them have then an entity in one of the European Union member states.
Well, that gets me to kind of my next question. What's the geographic reach of this regulation as intended? Is it anybody who's providing the service to EU people or members, or do you have to have an actual foot on the ground in the EU?
Yeah, it's actually providing any of those services that are defined by MiCA to the EU citizens.
Okay.
And
Well,
you, as a service provider, you have to have a toe on the ground.
Exactly.
You have to have a legal entity in order to
To
provide goods and
provide the service. And
services.
then, exactly. And also being compliant, which in certain extent means, yeah, specific licenses.
Yeah.
so that seems like it's going to be a problem given the nature of these technologies, right? Like you could have a Swiss entity that develops a cryptocurrency, right? And it's the cryptocurrency is traded all over the world. Maybe they're actively involved in trading it, maybe they're not. But it's going to end up back in the EU. But they're going to say, perhaps righteously, we had nothing to do with it ending up in the EU. We just put it out in the world, right? So,
Which is why they're targeting the service providers. If you're an exchange or a custodian, and you have to decide what you're listing.
yeah.
So if
So
you're listing a token that does not have a presence within one of the 27 member states, then you can't list it.
okay. So
And
all
they're
right.
doing the same thing here in the US, aren't they?
Yeah.
Coinbase is sometimes, they're like, no, we can't list this currency. We can
Yeah,
list
exactly.
this crypto, but not the other one.
Yeah.
Yeah.
And that's often based upon the current state of the art on the active regulators here, like whether it's a securities offering, et cetera, under SEC rules. Yeah, 100% they are. And that's a good pragmatic approach because most people are going to deal with an exchange in some way. But if it's actual peer-to-peer, they're going to have a harder time, right? Like if you're going wallet to wallet on these currencies, it's going to be difficult to kind of force compliance.
Well, I think MiCA obliges, and Marina, you can correct me if I'm wrong, but I think I remember reading somewhere that even wallets need to do their AML KYC.
Yeah,
You
so
can't,
that's
you can't avoid it by saying, oh, I'm going to use a wallet and I'm not going to use an exchange, and I'll get away with it.
yeah, I think that those are like, I would just introduce two different concepts here. So one first is it's very interesting to think about what can be done in a peer-to-peer way, and then seeing what actually peer-to-peer way is. So just transacting within peers in a way that, I don't know, I'm sending something to my friend, a crypto asset to my friend. Me as a person, I'm not regulated because I'm not a service provider. But then when we think about peer-to-peer system, as maybe think about DAOs, maybe we think about something like a DeFi system where they might not be a legal entity linked to that, or they could be just like a smart contract with a kind of community around it. That could be problematic. So decentralized finance within MiCA, which is like, just to start with, it's great. It's actually really good because it brings a lot of legal clarity within the EU. As I said before, at this moment, we have a very fragmented system. But when it comes to decentralized finance, there's already like some, depending on the draft, because now we have three, but there is a probability of like significantly hindering the DeFi use cases. And there's basically a ban on decentralized stablecoins, or it is needed to be in a way how compliance is drafted for certain use cases. It's also impossible to be compliant just because of the way how they issue their tokens, for example. When it comes to issuance of tokens, it is required to write and issue a white paper, which would be very similar to a prospect when you do an IPO. And there are different types of information that needs to be written in the white paper. And there's also regulation around how you need to market this activity and the white paper. And if I go back to the proof of work system, with the latest draft, there's also a requirement to write in the white paper, the energy consumption part. So how much this whole system uses the energy and how this is like designed within the system. So this could be also a potential like problematic part. which is like, I think it's kind of a normal, just because decentralized use cases are very, very hard to regulate. And then the second part, regarding the transaction within wallets and unhosted wallets, it's basically regulated by another group of regulations. We have a whole AML package right now within the EU, which is also very important for crypto. And just right now, at this moment, there's a travel rule discussed also within the EU, and it does require all the service providers to exchange information. So it would also require service providers of unhosted wallets to exchange information as a KYC, similar to others that are doing already, as like you might know, exchanges, they do have hosted wallets within them. So it's easier to provide this information. But just from the technical perspective, this is basically impossible for the service providers of unhosted wallets to exchange this information between them, or between them and other service providers that might have a different system, how they handle their wallets. So that's basically a thing that many times when it comes to blockchain and regulation, some things are maybe too early, some things are just like maybe, I don't know, too late, or they're a different time frame. And here the problem is, I think, the technical infrastructure underneath unhosted wallets and how all those systems work.
I think one of the things that probably merits stating at this point is that all of these regulations and legislations that we're discussing here are for businesses. They're not for individuals, people who engage in their own private business, their own private affairs. It's for their personal use. They're not engaged in a business and providing services to third parties that they may or may not know. So if I have a ledger doggle, ledger account, ledger key, I should say, that I use for my personal use, am I going to be subject to these regulations? Probably not, because I'm not in a business. It's not a business. It's just, I'm doing my own thing.
Yeah, I would say this is correct, but then I'm thinking about the entity that is in this kind of transaction that is a business. So the service providers that offers you an unhosted wallet, and like sooner or later, you are also going to be probably transacting with an exchange or another business. And in this case, the business that is providing you a service of a wallet would need to make possible for you and for their wallet to exchange information with this exchange that has a hosted wallet. So I was just yesterday, I was at a meetup when I was talking to one of my colleagues. He was working for one of the biggest exchanges in Europe, and he was saying that in the Netherlands, they already have a similar regulation, which requires you to give proof to a regulated entity that the unhosted wallet you have is yours and it is in your possession. And so it doesn't say how you do it, but probably you would take a picture of you holding it or something like this. Then you would probably, or they would send some crypto assets to you. And then, similarly as it's done right now with bank accounts, then you would go back with a number that they sent or stuff like that. But that is already required in the Netherlands. So I think something like this would probably happen in the EU.
Yeah, well, there are also a bunch of teams that are working on projects for identity and how you can provide that kind of information without actually providing the information, using zero knowledge proofs and things like that. Identity is a very big subject in this industry, because the security guarantees provided by some of these networks, the distributed networks, do also provide those security guarantees based on identity of a miner, whether that identity is known before or after, if it's a permissionless network, and so on and so forth. So being able to, figuratively speaking, have a token that represents my identity, and providing then the ability to exchange or to transact on a network by making reference to this deterministic data that's in my wallet, might be a way around a lot of these things.
Yeah,
I think that's-
and Marina, I think a good point too, that she's talking about KYC requirements and how the Netherlands is kind of operationalizing these. The point being that although the KYC, which stands for Know Your Client, for people out there, AML, which is anti-money laundering.
Can you define travel rule as well for other people?
Not in any way they'll make sense. But the idea being that although the regulatory burden is ostensibly on the service provider or the issuer for these KYC requirements she's talking about, what the requirement on a fundamental level is that those entities have to collect information about who you are and confirm who you are and keep that information. Now, the technical things that Alessandro is talking about has to do with what identity is and how that's collected in a modern age, but that collection is going to come primarily from you, and that could be active or passive depending on how you define a relationship with that entity. So even though the regulations on the companies, there's still going to be some burden on the users when these regulations come through. And just to circle it back to US regulations a little bit, the AML and KYC regulations exist in a number of places, but one of the main places is the Bank Secrecy Act, or BSA, just to kind of reorient people on the US side. So it looked like, Alessandro, you and Marina both had things to say in response to that.
Go ahead, Marina.
Yeah, I actually was saying that the identity is very interesting, especially in the context of blockchain, because we can define it in such a different way and in a way decide what we want our identity to be, or what is the information that defines it or that is needed in order to define it. But when it comes to regulation, there's already defined what an identity is and what kind of information you would need. So I think that it would be very interesting to see if there could be kind of a more light-weighted way of how much information is also shared and when it is needed and what is exactly needed. And again, thinking about not only reacting to what the technology brings to us, but maybe thinking, can we combine the solutions that the technology actually enables with the existing laws that we have? And here, I think it's also important to say that we have the GDPR in the EU, and whatever solutions there would be in order to maybe help being compliant with this AML rule, they would also need to be compliant with the GDPR, which is quite a sensitive topic in the EU. So yeah, it's definitely a very, very interesting, I think, discussion. We need to do like another
it's a whole different podcast for that. We're not going there today.
But just to orient people, because it's another set of letters coming at them. The GDPR is the General Data Protection Regulation, which is the EU privacy framework. As with this digital asset idea, the EU is farther along thinking about privacy in a fulsome sense than the US is. The US doesn't have a general federal regulation governing privacy. There are kind of a patchwork of ideas on the state level. It's still being worked out. There's some movement to come with a federal system, but it's not there. The EU has it. And in this digital asset context, and in the privacy context, the US is kind of just starting the conversation. So unless anybody else has something else to add, we are up over 40 minutes. It's been a good talk, everybody.
Yeah, I think I think probably at this point, I'd like to introduce another concept, which is the socioeconomic use of these networks. I myself, I come from a traditional business background, and when I see that, I don't know, 15, 20 developers can get together and build a blockchain that's worth billions of dollars, or almost $1 trillion in the case of Bitcoin, it intrigues me. It's like, okay, how do I understand this from an economic point of view? And the interesting part for me is you've actually built a network of literally hundreds of thousands of computers without investing a dollar. And these computers are able to use a more technical term, maintain the state of the network, i.e. they all have the same information at the more or less the same time. Then they all have different security guarantees and so on and so forth. This is very different than, I have a record, a database in a computer that I control, or in 20 computers that my consortia controls. Consequently, it seems like it's possible, and there are people within the industry who do work on these issues, to build out networks that use this computer technology, these distributed platforms, these distributed computing platforms, where everybody who's set up their mining operation gets paid in the same terms and conditions as everybody else, regardless of whether I'm in China, the United States, El Salvador. Doesn't make any difference. We all get, if we mine a block, we get the fee and we get the mining reward. This gives a very high level of productivity. It also creates a more complex way of managing all the people who are on the network, because we know from history that even if we have nice distributed networks, there is a desire always to collude and to concentrate power and take over. The Ethereum community, for example, they had the miner extracted value problem, where miners were making more money by extracting value from the network than actually mining blocks, and so on. But it does open up the opportunity to create new business models where you can have very high productivity gains. Not to talk badly of lawyers, but you can put lawyers, accountants, compliance, all of your back office into a smart contract. That's a huge efficiency gain that you can get, and that allows you to then create these new economic systems where people can find employment, where people can participate, people can create community, and communities that span the whole world. Back in the beginning of these, I think in the Ethereum community, but maybe it was before, the idea of having a distributed Uber was something that a lot of people were thinking about, and some people were actually trying to do. I don't see this legislation, whether it's MiCA or President Biden's executive order, targeting these particular types of businesses, these particular opportunities. But maybe I'm mistaken. Marina, do you see anything there within the MiCA legislation?
Yeah, thank you for this. I think it's very important to distinguish kind of the legal effect of certain technologies or like business use cases that we built in this ecosystem. And I think that like the way how the regulators or lawyers would look at it is more of a what kind of a function they have or what resembles something that they already know from the legal perspective. So we like to use this term of like token or a crypto assets being a container, which is basically something that, of course, it's like very defined, but by its like technical, I think, infrastructure, but at the same time, it does contain something that might resemble a financial instrument, or it does contain something that could resemble something else. And of course, in many cases, it just contains something that is completely new. MiCA defines many new terms that didn't exist before, like a utility token. So that's a completely new thing. And then when they define a new thing, they're trying to see, okay, how it is different from, again, what we know. And many times when you're talking about a socioeconomic aspects and ecosystems, we also think about organizations. So MiCA is not, I would say, in any way trying to define a new organization as a DAO or defines a DAO in any way, because it's not the regulation that is used for this. It would need to be done in a completely different way in the EU. But just by defining the issuer of a token and how it defines, it is kind of going into this direction, or at least showing what a like compliant issuance of tokens would need to look like and who can do that. So I do partially agree to what you said.
Yeah, but I think this is where we get into we'll call it a nuance. If I remember correctly, in the MiCA legislation, even if you're issuing a utility token, you have to register with some entity, some state entity. Whereas in the United States, it seems to me, and I may be mistaken, Chris, you can correct me if I am, utility tokens are being left alone. They're under the CFTC and not the SEC, and they're being, Bitcoin and Ethereum, because of they are sufficiently decentralized from a financial perspective or a financial markets perspective. To be more precise, they're being treated as commodities, whereas Europe is still sticking their finger in the pie.
That is the current state of things with the CFTC looking at them as commodities. There is, right now we're in that intermediate period. The executive order's gone out. It's asked the Treasury Department to look at this. It's unlikely the Treasury Department weighs in on the kind of tokens you two are talking about from a socioeconomic perspective, but they may see it as a directive to start doing that. And they may be very wise to do so. Right? Like, who knows where the next iteration of this will be in these technologies, but it could very just tie to that ID issue that we've been playing with on the KYC perspective, because the idea of IDing people is kind of what's been driving the targeted advertising goldmine. And if that ends up being articulated from a token perspective in the next iteration, it's something that the Treasury Department may very well, or some other federal agency may want to wade in on from a non-commodification perspective. But that's all future talk.
Yeah, well, the marketing machine that we've made out of the internet, probably has to stop too. It's problematic. There's way too much value being absorbed by very few actors at this point.
And the GDPR is a reaction to that, right? Like,
In part.
Yeah.
So it's also because they don't have any in Europe. They don't have these big companies. They're all American companies or Chinese companies.
yeah, they're American,
Europeans don't have anything.
but they can't avoid the problem. I mean, because a lot of them have parked a lot of their assets in Ireland for a number of reasons, tax and otherwise. So they're not beyond the reach of the EU in fundamental ways. It's also a market they're not going to want to give up on. And then also Europe is fundamentally better situated to talk in a nuanced way about privacy issues because they've been wrestling with it since before World War II in very concrete ways. Whereas the US conversation about privacy in the way we're talking about now is newer. It's still, it's still kind of a newborn idea, where it's a mature idea in the EU. Yeah.
I just wanted to circle back a moment because I see we're almost out of time here. We started this call with you mentioning the central bank digital currencies and the executive order, asking the Treasury to take a look at it. This is a subject that I think every government is wrestling with around the world. The question I often ask myself about these discussions is whether we're talking about a retail or wholesale central bank digital currency. So if I look at the Chinese example, the central bank digital currency, we'll call it that for, without going into the merits of the technology, anybody can use it. It's a retail product. Whereas because we have our commercial banks behind the central bank, and there's this the strength, we'll call it, of the reconciling or the reconcilability between ledgers. When we talk about a wholesale digital currency, it's targeting more the relationships between the banks themselves and not necessarily with the retail customer.
Yeah.
I mean, theoretically speaking, this type of technology puts an end to double entry bookkeeping if we really want to go anywhere. But it does help with these reconciliations. And I don't know what your view is, or if you have one, regarding whether the US or any other government should be looking at retail or wholesale digital, central bank digital currencies.
Well, what I often do is I kind of look at things from a historical perspective, because even though this is new technology, there are always lessons learned. The history of money is fascinating. The Neal Stephenson books and the Baroque Cycle and Cryptonomicon are great on this. But just the idea that starts off with it's all barter, right? And then it's a hard reservoir value, gold or silver, something like that, right? And then the fungibility of the coin has to do with the purity of it. And then the purity doesn't matter as much as the strength of the central government and the exchange. So all of a sudden they're moving off of the direct value you can get off, and then it's a medium of exchange. And then you get to paper money with no intrinsic value to the medium of exchange. But in the background behind that, the major business transactions are already being done upon the idea of money. Is supposed to in reconciliations. So that like the trade terms in shipping, like full on board, are international terms that have existed back to Sumerian times, right? And have a independent meaning to them. Some of the earliest writings we have are reconciliations of trades. Returning back to the timeline, we have paper, but paper backed with gold or silver standards. Taking them off of the gold standard, all of a sudden it's just the idea of the exchange. Once we're off the gold standard, then why does it even have to be paper? That ends up being assumed to a certain extent by the framework built around the credit companies and the reconciliations between banks. It seems like when we have 100 more years of perspective, it's going to feel like an unbroken line to a purely digital currency linked to like robust enough protections. But to answer your specific question between retail versus wholesale, it feels like the way for Treasury to actually get this done in a way that adds value the most in the short term without worrying about adoption problems is in the wholesale level. Being able to take away some of the efficiencies, the inefficiencies in the exchange and reconciliations between the banks will add a lot of value very quickly. Will internationalize money, make credit cheaper. It feels like those are things that could happen if we could secure it. That feels like kind of finite but important project that Treasury would be good at building out. And then once you have that in the back, being able to roll then out the digital applications of it as a day-to-day currency. It's going to be hard because if it's a wholly digital medium of exchange, you have to have people engaging in digital life, right? Not everybody does. They will probably in the future, but you also have to respect their decision not to. So what then do you use? I mean, that's where you end up colliding with privacy again, right? Because identity could be how you secure these things or identify yourself. But biometrics, I mean, that's something people aren't ready to do yet, right? Is it going to be some version of what the social media companies refer to as the P cookie, the persistent cookie about your online or otherwise credit existence, and that reconciles who you are in the only way that matters, in the way that you spend your money? Maybe, but those are all held by private companies now. It's probably going to be something else, but it'll be exciting to see. And then again, to answer your question directly, it feels like the bank-to-bank government reconciliations is the first big project that can roll this out, and then top down to get it out to everybody else.
Marina, is there anything that you want to say on this subject with regard to the European Union's central bank digital currency initiatives? Because I know that they're a little bit further ahead than the US is on the subject.
Yeah, there was a report issued by the European Central Bank. There was like a kind of a follow-up report and decision on how and where this would be going forward. But what was very interesting to me is just linking to what Chris just said. Privacy is one of the most important things for Europeans. And this is also something that the European Central Bank recognizes and said it will be taking into account, because that could be the problematic part when it comes to the digital money, digital euro. So right now we have the right to use cash, which means, you know, we do have like this kind of a level of privacy that we're used to, and then thinking of how can you even do that in a technical way. Some suggestions when we were discussing with colleagues was also thinking about using zero knowledge proofs, if blockchain in any way would be a part of the solution for the digital euro, because this is still not clear. There's been some research done, some pilots, but in that draft that I was reading, it was like a few months ago, there were like 3 options, and one of them was also an option where blockchain would be used or DLT would be used. But some of them are also options where blockchain would not even be used. And of course, as you were saying, I think Sweden is the most digital country in Europe. Almost everyone uses
cashless society. Yeah.
Exactly, cashless society in Europe. But when you go to Berlin and when you think about how German citizens think about privacy, it's crazy how much cash they use. So you see, Europe is very different. And I think that, again, there's going to be a compromise needed. And I think that the kind of a blockchain DLT community is definitely a part of it and is going to be a part of it in the future.
And anything with regard to wholesale or retail digital central bank digital
I think
currency?
that was already defined by this report, which means that that would be issued by the Central Bank of Europe, and then the other banks would be very free to think about different, I would say, strategies, but also business cases of how they would use this digital euro. So it would be kind of they would have the freedom to do that, but it would be issued by the central bank.
Another thing I want to add on the US side is because so much of monetary policy in the US is done by the issuance and reconciliation of governmental debt, that one of the ways that they might roll this out is to have all of the redemption for bonds going forward, US bonds, be digital. So then that would put 10, 20-year horizons on most of the money coming in and out of the government being digital, and give kind of a growth curve to it. I could see Treasury using that kind of model, among other things, because it's their main trick to do monetary policy.
Yeah, well, we'll have another discussion about the long-term debt curve at another day that should be abolished. And this technology could possibly help resolve that issue, because today nobody really has any solution. It always amuses me when I listen to the news or read articles about, the central bank this and the central bank the other. The central bank is a lender of last resort. We should not be depending on the central bank, whether it's the European one, the American one, the Japanese one, as much as we are. This is ridiculous. It means we can't sustain ourselves as an economy.
But like you said, Alessandro, that's another podcast.
It is, but
for now,
you brought up the subject, so it's so important to me.
So now we're at our time limit. Thank you all for joining. I hope to see you guys again soon.